The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Tiger Technicians Hour, my pleasure to be here Monday through Friday, market days, and of course, I'm the fourth in the lineup, and we've had fabulous shows all the way through. John Logan, 8 o'clock. You've got, let's see, so 8 o'clock, 9 o'clock. Of course, Larry Pesavento at 9 o'clock. Tom O'Brien at 10 o'clock. I come in at 11 o'clock. Today being Wednesday, you've got probably a repeat. Then you've got Steve Rhodes, 1 o'clock. You've got Dave White, 2 o'clock. Tom O'Brien, 3 to 5. Just a full house. Just great, great shows. Here we go. The pattern that we were looking at was a lowercase h that goes to a lowercase m, going to a larger arch formation. Here's the E-mini 120-minute chart. Goes to a lowercase h, makes the lowercase m, holds the low of 1831, goes to 1850. If you're looking at my charts, this is the 120-minute right here. Then it starts a spectacular move up, goes A, B, C, D, just above the previous arch high. That's a clue to say that you're making a bigger arch, and lo and behold, it goes to 1992.75. Second peak D after an instant restart. I meant to do this just to show you exactly what it is. I put them to plus signs, but there it is. And it goes to a peak D at 1992 underneath the 200 period exponential moving average. And then what happens is starts the left side, right side price time. It comes back down and it tests the lower bar of the 26 at 4 o'clock. The low was 1892.25. And what does it go to? It goes to a low of 1898.75. And that was on the first. Today being the second, this is the bounce that we were anticipating for subscribers. Why? Because my Chapman wave trend gauge showed that a very high reading, almost a cluster reading of the second day. I didn't know whether it'd be a third day, but at least the second day at 5:52 on the trend gauge. This is Richard Arm's measurement of the highs and the lows subtracted from the high, up volume, down volume. And you basically what you've got here at 5:52, it is extremely high. In fact, if I pull this back, you'll see that we haven't been to 5:52 for a very long time. I'm still pulling it back, 5:52, 5:52. In fact, we haven't been there for quite a while. Hey, does that mean that it's all over, that we're now looking at an upside move? No, I think that this is just part of the vernacular we're looking at. Higher highs and higher lows in the stock market. Yesterday was an extremely overbought and intense selling pressure phase. And basically what we're looking at now is we've got a rebound. But today I've already got an indication. I wonder how long this is going to last before this particular technique gets taken away as well. We're at 0.32 and as the low so far today. And that suggests to me a low reading that there should be a sudden pullback in the Dow tomorrow going to a negative opening. No matter where it is in the futures are tonight or even in the morning, there should be a pullback tomorrow that takes the Dow down a little bit, and then we'll see whether a buying pressure comes back again. So in the meantime, back at the ranch, pattern that we're looking at here is the arch formation. It took out the trend line that was holding, number one. Number two, it has arched over enough to say, you better rally right now, because the best case is another M formation. A lowercase h goes to an M formation in the daily chart of the Dow. But I can just tell you this. If yesterday's low of 15,979, if we close below, if the Dow closes below that, then this dash pink Chapman wave inside wedge target line becomes the next level of support, around about 15,740. The low that was made a week ago, Monday a week ago, was 15,370. Whether we get there immediately or whether we take time, it doesn't matter. We will be getting there based on this Chapman wave methodology of the Roman candle. We've used up some of the upside ability, and now we'll see what happens to rallies. And it's going to be very important where we close today and tomorrow Why? Because this little mini arch formation says that unless the E-minis takes out 1941.75, no, it really can't take it out. It has to close decisively above. It has to close near the 1950 level. And then all of a sudden, we've got another chance to rally, maybe even test higher levels before we start to come down again. I have to tell you, looking at many of the charts, be very cautious. That's all I can say. Okay, now let's take this away. Here we go. Move it away into the corner. Into the corner. Put it over there. And now we're going to run some other things. Let's run the numbers. The Dow was up 200 points. It's now up 130. That makes the low of, as I said, the low of yesterday, actually the low of today. You take out 16,000, You take out 16,100 by the end of the day, and that'll be terrible action. I suspect there's just enough rally energy left to try to rally. The high today so far in the Dow is 16,283. I would not be surprised if there's an attempt to get close to that level. And if you get even close to that level, there's a chance that that 16,269 period exponential moving average in the 120-minute chart could become support just for another day or so, as there's a counter trend bounce. Okay, let's go. So the resistance is up at 16,430. If there's any double strength, in other words, if there's strength today and then strength tomorrow, my suspicion is that as we get towards the 16,230 to 16,260 area, there will be mixed buying, but there'll be a lot of selling saying, hey, dangerous market, I want to get some of my stocks away here. I want to get some cash. SPX had a huge move as well. It went all the way this morning to 1938. And here's the 120-minute chart. This one failed to make a peak D. It went to peak C1, C2, pulls back. The 9-period moving average stopped it right there at the 1938 level. And now what we're looking at 1926, up 12, is hey, not bad action. But after yesterday's move, a rally that takes above 1932, that holds, is what's needed by 2 o'clock to be able to close at the high of the day. Going to be a very interesting aspect to the markets today. The comp index is up 41 and 46.77. The QQQs had a fabulous run from the low of 84.74 back on the 24th of August. Went all the way to round number 106, pulled back fairly sharply, but really not sharply in relation to the 22-point move. It only pulled back from 106 to 101. 100.63, 6 points, big deal. But what's most important is this key support level at 99.80. Any close in the next 2-3 days that takes the QQQs under that number, and this candle, this huge wick, this huge body with a long wick from last week starts to see the 99.36, the 90. This one here, 98 level. Those are the levels, 1 point increments on the way down as support. It has to hold. So this is a very important moment. And the monthly chart is suggesting strongly that this is a peak D at 114.39 with all the other indices. Okay, let's quickly go to gold. We don't have to do it quickly. We'll go to gold. And gold right now is down 5. Am I late? Or am I? No, that's right. Between $5 and $6 at 11.33. Just yet another, oh man, this could be another arch formation right there. So it's really important for gold, if it's going to show strength, it has to show strength by the end of the day and into tomorrow, and it has to take out 1147.30 on the continuous contract. It has to do that, because if it doesn't do that, then you've got this arch formation that says, oh man, I'm just going to come back and retest the 1120s, and I'm at 1134 right now. And if you look at the dollar, here's a relationship. See the strength of the dollar? An inside day so far. Did not tuck underneath the low of yesterday, 95.19. Today's low is 95.42. And that's suggesting that the pattern that I've been drawing here of an arch, of a cup formation could be repeated once again in a smaller gesture as the 90. Remember, we're talking about, for ages I've been saying 96.30s to 96.50s. dollar has to close in that area to show that it's got the kind of V-shaped strength that can take it to the 97.08, 97.07 highs back in mid-August. It's very important, but holding so well is a good sign. And EUR, USD, this is the euro-dollar currency pair. Another series of arch formations. Nothing to see here, folks. Just move along. Let's go to the USD JPY, and that should be up. Yep, it is up, but it's holding the 200-period moving average in the daily. I suspect that the dollar Japanese yen currency pair won't move the same way as the dollar. In the direction maybe, but not as precipitous a move. If the dollar does break that 96.80s, that'll be really positive. Now, this is the dollar. I just did it again. Didn't mean to do that. What I meant to do was to show you the bonds. The TLT, the 20-year T-bond fund, under the 200-period moving average at 121.29, down 74.30 seconds. Most importantly, it's under for out of 1, 2, 3, 4, 5, 6. Out of 6 sessions, 1, 2, 3, 4, 5 of them have closed under the 200, this coral-colored 200-period exponential moving average at 122.10. Right now, bond, the TLT is at 122.26. Now, I've discussed this and I've said, my suspicion is that bonds are just in a trading range, that the Japanization of our bond yields is continuing. Hey, I'm saying this, and within another 3 hours, in another 3 hours, you could see something absolutely phenomenal. You could see the TLT trading either at a 119, something like that, as the Fed says, we're going to raise by a quarter point, and there's this scare in the bond market. Or you could see nothing happen and a sudden spike to 122.50s where the 200-period moving is, and that would be above 122.10. As it stands right now, I've said this for a while, if you're looking intermediate term, it's very difficult to put a position on the TLT that's either short or long, because the whip to the upside or the downside can be quite vicious, and it can gap. So I feel safer just looking at this as a trade. If I was basing it on the monthly chart, I'd say that peak D at 138.50 made in January of this year. The pullback has been very steady. It's about a 50% pullback to the low of 115, having come off the December 2013 of 101 all the way to 138. So you can see 16, 17, this whole area of 11, 16, 17. That's your halfway point. And so far, bonds, well, this is a continuous contract. When they smooth it out, the letters can fly all over the show. But if you're looking at this, you see this long-term uptrend support right here. It says that if bonds at any point break 145, that's 10 points lower than where it is they are right now, that's going to be the first sign to say bonds are starting to break, yields are starting to rally very sharply. As we go out, I just want you to grab the utility XLU. XLU has gone to a lower low. Oh, I need to look at this in greater detail. I'll be right back. Basil Chapman, Tiger Technicians Hour. Dow's up 148.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Dow's up 161. S&P's up 16. Basil Chapman here. And the utilities are at minus 14 at 41.17. They've just dipped the last 2 days underneath the left side low bar of 43.41 back around the 26th of June after peak F doji candle high. And this is going to be very important because the stochastic and MACD are at a point where you should start to see some stability. You don't have to, but this is about the area that you would. The weekly chart went from a low bar back in August of last year at 41.18 and went all the way to peak A, B, C, and then a D at that high of 49.78. Huh? Oh, yes, 49.78. Plunged A, trough B, trough C, and then this week is going to leg D after that bounce to the 46.14 level in that Eiffel Tower, straight up, straight down, uppercase A pattern like this here. Let me just draw it so you know when people talk about the Eiffel Tower. It's an expression I developed over the years because it looks visually. I like to use the technical terms that are descriptive, that actually explain what it is. So that it might be a long sentence like a Chapman wave flat base restart or something like that. But in fact, all it does is it explains in a very clear way. And there's that A. Look, it goes straight up and straight. It looks like the Eiffel Tower. And there it is, straight up, straight down. Came back in an even quicker time and broke the left side low. 40.25 is the 200-period moving average in the S&P Select Utility Spider Fund weekly chart. And it's in leg C down in the monthly. Now, this is very unusual because the utility index has not had anything like this since the 2007 December high of 44.66. And it came down A, I believe that was exactly the same. Let me just check. It looks lower. 3605, 3610. Yeah, A, B, same thing. A, B, C. Trafcina started this whopping rally from the February, 1 month before, no, March, the month of the low of the Dow and the S&P in 2009, and it screamed from 22 to double, more than double, to 49.78. Here's the question, great question in the den. The den is our trading. This is the chat room. Sort of a trading vehicle where people look and tell us what they're doing or what they're looking at, give comments, give descriptions of what they've read that are very interesting pertaining to the economy or anything that pertains to the stock market. And the question I had was, utilities a precursor of what's to come in bonds? I think that's a great question, except for one little thing. Never in the history of the stock market you've had manipulation by the Fed before in many other ways, but in the way that they've handled the economy since 2009, the way they've handled their side of the bargain that has helped the stock market and in some ways the economy, that's the better way to put it, has been fortuitous. Maybe we'll pay a big penalty for it, but I always say, hey, Dow 16,200 is a lot better than Dow 6,600. You know, people feel a lot better and the country feels better when the market is moving high. They might hear the politicians berating over and over the economy and saying, you know, this is a terrible economy and the job situation, etc. But actually, we've survived to now really well. This is the one thing that I've whenever I discuss this with my friends, I always say, you know, I've never understood why President Obama didn't make a big deal about the stock market going off major lows, major lows, to double and then in some cases triple during his tenure. I think that's commendable. That's what you've got to be talking about. I think it's really important. But he's you know, he might talk about being anti-Wall Street, but in fact, almost all the people around him over the years have been Wall Streeters, mostly Goldman Sachs folks. So I don't understand it, but you know, you should give credit where credit is due, and I don't understand that part of the bargain. So I'm looking at this and I'm saying to myself, technically, I would never have said the Japanization of our bond yields, a theme that I've had for about 12, 13, 14, I don't know how long, would unfold in the United States, especially if you said to me the stock market has gone from S&P 666 to over 2,100, where do you think bonds would be? I'd say, oh man, bonds must be way down, yields should be higher. This would be the typical thing. And all of a sudden, you've got something very different. So when people say it's different this time, and then others say, oh, yeah, sure, it's different this time. Yeah, it is different this time. It is absolutely different this time because the Fed has been really instrumental in propping up the stock market. There's just no question about it. So for a while now, it's been there's a subterfuge going on. It's not quite the same as it was. So that's why this thing with the bonds is really important. Now, I've got a break coming up. I want to take this moment during the break because I've caught up now with some of my notation on the XLU, which is the S&P Select Utility Spider Fund. I'll have a look at it in a little bit more detail when we get back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, so let's just continue with this theme, XLU. What I'm looking at here is that the low bar in the monthly chart of 40.07, made in August of 2014, can give a left side, right side price time match to the high that was made back in January of this year at 49.78, going to November. But that's a point or so away. In fact, it's a point and a fraction away. That's just way too close. So the next thing is this down channel that I'm looking at, and it says if 39 to 38 support goes in the next 2 weeks, in other words, we go right through this level, then you don't really have support until you start to get to the 37 to the 35 area. So that doesn't mean to say that the price doesn't have to, it won't stop, it'll just keep going. What it does say is that all of a sudden, because you have to use other indicators, shorter term indicators. Maybe you have to start looking at, let me just double check this. Maybe you have to start looking at the weekly, etc. The weekly has 40.24 as a 200 period moving average support. And then what happens is it's kind of empty until you get to right there, 40.07. Yeah, all of this is very close by. And look at that candle from this week alone. That is very ugly. And it's got a volume attached to it as well, which says that that 40 to 39 area is going to be just really important support. It has to hold and make some kind of a bounce. Now, a couple of things going on. How does it relate to bonds? I think in a sense, The trend, look at this. Let me show you something. U.S., this is the continuous contract. Remember, January was the high in the XLU, and 164 and 17/30 seconds was the high with a Chapman wave 2-bar decline in February, just fractionally off that high. So there's your January was, in fact, peak E. So we have matched it to a certain extent. So absolutely good point was made that there's a correlation. It isn't sometimes an exact month-by-month correlation, but it is a directional correlation. So when we saw the immigration of money going from the equities to the bonds, and then back from the bonds to the stocks in this really whippy 2015 period, basically what it was saying is that the Fed, how can I put this? That the Fed propping up of bonds might have run its course because the market has pulled back from 18,351 in the Dow to the 15,300s, and yet bonds should have broken to all-time highs. They should have gone above. They should have gone to the 165s, and they haven't. So my suspicion is that maybe, unlike Japan, which went on for decades, maybe we're running out of time, and then when I do this to the TYX, this is a wonderful chart. Look at this. The TYX, which has not broken upside yet, but look at this. For anyone who's not seen these charts before, this is a monthly chart of the 30-year Treasury bond interest rate. This is the yield. And look at that. This is just to talk about 1987. This is just the channel. This is not the high, which was September 1981, back in the 140s. This is talking about the yield coming down in a channel that did not break either the upside or the downside in all this time. It was just like a tube was on its diagonally sloping down at about 18, 22 degrees, about 18 degrees. And let me just see exactly what it is. Let me see, 18 degrees. I'm going to put this up. I've got a protractor right here, and it goes this side. So it goes that side. 20, I think. Whoa, no. No, it's not at all. It's more like 8 degrees. 8 degrees of separation. There we go. No, surely. I'll check it out. I think that looks more in the teens. Anyway, this very gently sloping down channel, and we're in the upper end of the channel. So what we're looking at here is, so far, there's been no break to the upside, and at 2.94%, you'd have to get to 46. You'd have to get 4.6 to really start breaking it, and you'd have to hold it, actually, to really break this down channel. So the Japanization of our bond yields, in other words, going to almost zero, is still intact. We'll see what happens. Maybe this afternoon, all of a sudden, we get a big change. And in the short term, the TYX is running. It's in leg B to the upside. So, yep, you can't ignore it. The stochastic's at 90%. The MACD is good. That says that bonds on the very short term could go a little higher. And that's very interesting. All of a sudden, you've got yields going higher, bonds coming down, when bonds should be going up and yields coming down as the stock market plunges 500 points. So we're seeing a deflection in the thinking, in the prices. Something's going on. So we're going to be watching this real closely. If you look at some of the sectors, for instance, the SMHs, we took some of our profits in the, once again, we actually had 100% profit in one of the positions in the short, 200% short, the semiconductor. But look, the semiconductor is very important. It tells us about the business economy. It tells us about other things. It's not anywhere as important as it was. It's the commoditization of everything. In this case, of course, we spoke about this ages ago, the commoditization of the semiconductor industry itself, let alone the semiconductor chips. Now what we're looking at is the SMH has had a really strong rally from Monday a week ago in percentage terms, from under 44, from 43.50 to 50.12. That's 7 points. That's, what, 16, 17%? Good rally. And the stocks, of course, came down proportionally to that. But look at this. when you're looking at the semiconductors, and yes, in the den, Amber got spanked. This is a very interesting stock because it's directly related to GoPro, and it's down 10 points at 78.81, down 12%. I looked at it as a potential long the other day, and then we did not get it, thank goodness. And yesterday I thought, you know what? I think it's making the H pattern that should turn down. Now, maybe they had earnings come out, but it had made a peak D, Amberella processor on chip for camera surveillance, etc., for camera and surveillance, etc. But it made a G in the monthly. That's the only reason why I thought it could rally maybe a little bit more until it made that U-turn. And now we're looking at a stock that's given back most of the gains from last week. If this takes out 70, this is going to be one of the key stocks in the high techs that was doing very, very well. So, okay, let's run around. I want to run around. We spoke about bonds. It's real clear. Let me just go back to the bonds. If the TLT closes under 119, it says be careful. It can test the 115 area, the 200-period exponential moving average. I still think this is stuck in a trading range. But if it breaks to the upside, it has to go all the way to 130 to say, I'm on my way to test the 138 top. So all I'm saying is I think it's stuck in a trading range. Let me just show you something here. A, B, C, D, A, B, C, D. Okay, so the E-minis, I just wanted to get out of this right now. Pulling back. They're really struggling. I mean, this is not the kind of action you want to see after an incredible down day like yesterday. The give back day should have said, right now we should be, no, we're not. We're 125 high. We should be at 180 to 220 on the Dow up, and the S&P should not be up 11. It should be up 19 to 25 at this particular point. So I'm just going to do this. I want to show you something very interesting. Now, I keep getting questions about my the webinars that I've been giving based on the relationship between now and the 1920s. And I really would like to do one fairly soon because the timing is just perfect based on that Elliott wave pattern with the Chapman wave methodology, putting the two together to show you that sharp move to the downside that we were looking for, wave 4. Meantime, back at the ranch, let me show you the bonds. This is the yield at 3.255, the high of the 25th of June. It really, it just took it on the chin. It went all the way down to 26.25 last week, and now trading at 29.43. That was a peak E, a peak D in the 10-year T-note yield, and peak C minus really in the 5-year T-note yield. And that never rallied anything close to what the 30-year did. So what I'm looking at here is, I believe this trading range is intact. But all I can say in the next 3 weeks, if the TYX, the 30-year T-bond yield, this is the white one here, if it cracks 32.55, I would have to consider that yields are on their way higher. It's just real simple. I wouldn't mess around. If it actually, no, I shouldn't say, I'm going to make it a little clearer than that. If the T-bond yield closes any week, this is a weekly chart, any week above 33.70, because just sneaking above 33.25 could be a double top. So I don't think that that's, I want to be very clear about it. You need to break out. And if it does break out in a brand new leg A or B to the upside rather than an F, all I can say is that watch out, because bonds will be coming down, yields will be going up. The market will be independent of all other factors. It's going to be really interesting if that happens. Now, the other thing is, look, the weekly chart of the HGX, the Philadelphia Housing Sector Index, pulled back sharply at a peak D. I believe that will not be taken out, not in the next month or two. This is the way I'm thinking. And wood, WOOD, is the iShares Global Timber and Forestry ETF, plunge under the 200-period moving average. It's now still under it, but it's trying to bounce, just to bounce, because this is a harbinger of other things. I'm not going to talk about, where was it? Not this chart here, not this chart here, not this chart here. Whoops. GC Gold. No, I don't want to do that. Okay, I want you to go to this chart right here. I said I would try to update it. I never did. So do I have the, there it is, S&P monthly chart. Look at this. On in May of this year, at 2134, the S&P made a peak G, Very unusual, peak G in the monthly charts. It has happened before, I believe. Was it the daily chart or was it the monthly chart in 1929? Oh, I don't want to jump to those right now. Let's just do one thing at a time. You see this beautiful up channel? Let's get rid of this. You see this beautiful up channel? You see the way these up channels have been absolutely spectacular. The way they've held most of the trading range, the support, and then the resistance, and then when the support breaks, all of a sudden you've got a down channel. Look at those beautiful trend lines. And the inside, that green one is the inside track buy zone. That's the sell zone with the red track going to the breakout green. Then it reverses. So you go 435.68 was the low back in 1994. You scream to the upside in March of 2000 at 1552.87. So that is a five. What is that? Three and a half bagger, right? You plunge down to 768, October of 2002, and then you run all the way back to the 10,000 to the 1576 level in October of 2007. Look at the channel. Look at the channel on the downside. And this is what I love to do in my to continue the thinking through a webinar. I'll see how we can fit that in. And now we've had this beautiful up channel to the upside, the resistance levels, the support levels breaking just once, like many of the others, just once they broke, and then they formed a beautiful channel, inside track support level. And now we are testing the red line. In other words, if there is a close below the 1867 low of August, the next level of support will be 1820. Not a big deal. 1867 to 20, it's 43. It's about 500 Dow points. No big deal. But a close below it says, uh-oh, now it's far more serious because the next level of support is way down at 1737, and we just continue to the support levels on the left side. Wait a minute. If you made a top in May, and you've gone 1, 2, May, June, July, August, 3 months, you're into the 4th month, go backwards and you'll see 1, 2, 3, 4, 5, 6, 7 months to that low. So that's saying if there is the Eiffel Tower or the left side, right side price time match, we should have another 2 months to the downside if the level of Monday a week ago, that low is taken out. On the upside, you're inside the Chapman Wave inside track support propellant line. Sometimes I call it the buy zone. It's always been a buy zone ever since the low of 66.79 back in March the 6th of 2009. But the severity of this decline, based also on this particular pattern here, that is something I discovered and have used. We've used it very successfully for a long time. I will hope that it's a successful usage this time of the Chapman Wave Roman candle in the Dow, in the SPX.X. It is a little different because we closed a tad lower than what I like to see to call it just a legitimate Chapman Wave Roman candle, but it has all the characteristics. Opens at a certain point, fractionally, again, moves fractionally higher, plunges and then closes halfway. Usually I like halfway to a little bit higher than halfway of the whole wick. This time it closed a little bit lower than halfway, but all the characteristics. Now, look at this. The MACD and stochastic are plunging. That says upside is extremely limited. I was trying to get that across over the weekend to talk about the larger aspect technicals. And I'm not sure I've succeeded in doing that, but that's really, the bigger picture here says lower lows and lower highs. Doesn't matter what happens in between, lower lows and lower highs. So with that in mind, we've got ourselves a break. The Dow's now only up 118, S&P's now only up 10. I say only because it should be more.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Hi, folks, that's right. It's Wednesday, so you got Daryl Martin. That's great. So Dow's up 92, S&P's up 7. Real quickly, I told some subscribers on Jeet, I said I'd look at INFN, Infinera Core, Optical Transmission Core. What I'd said before was that I thought that that was a peak E in the weekly chart, and that I'd be real careful. I'd start to take a little bit off the table. Most importantly, if this is a D, it's outlining for us in the monthly chart that at 2164, up 13 cents right now, you got to watch closely, because 1984 is the 9-period moving average in the monthly chart, and that's key support. The MACD is good, stochastic's good, so I would not say get out of any core position. I'm just saying to you, I would just be taking a little bit off in terms of money management. It could still bounce, have a bigger arch, and go to 2350, maybe even 24. I don't think it's going to make a new recovery high. And then you'll start to see if it takes out 18, That's far down. So 3 points down. But if it does in the next 2 to 3 weeks, that monthly chart is going to deteriorate. So I'm just saying, just money management, I'd be a little bit careful. I would not add to the position. That was that. And Nicholas, you want to just ask about, if I can remember now, ATVI. I showed this today in my opening call newsletter. I did this as the Groucho Marx eyebrows top at round number 30, all-time high on the 31st of August. I think this also has had a spectacular move. It's just time for a bit of a break, and I'm suggesting take a little bit off now. Yes, this particular pattern says you can go down 50% from the recent rally, 2404 to 30, so it could come back to the 27s. Watch out. If it closes under 27, it's at 28, 24 right now. If ATVI, Activision Blizzard, closes underneath 27, I'd be real careful, because that's the 9-period moving average in the weekly, and it's suggesting to me that that candle of last week will start to be filled in. Still your core position in 3 days' time. Let's look at it again. In the meantime, I'd just say a little bit off the top. I would take it. I don't think it's going to go to new all-time highs at this point, but it's the downside. So let's go back to the Dow as we wrap up. And don't forget, my services, the opening call. We had some really nice trades. So down, we're up 93. There's that H pattern. Watch out. A close in the next 2 days below yesterday's low of 15,970. Let's call it 15,950. The close below that level says, that H pattern is in place with a doji high. You're going to see a retest of the 15,500s very soon. You've got to see a rally but above 16,430 in the Dow to really save the day, and at least make an M pattern rather than the lowercase h pattern. That's going to be very important. As far as the VIX is concerned, the VIX is at 29.47. It's down $1.93. In the TVIX, we do not have a position. Unfortunately, we had it in the 5s and it ran to 19. That should be a 1990, not 9. The TVIX is trading at 1788 after a peak D. I believe if today it doesn't take out 1990, that'll be a peak D. But it's that single leg A up that's going to be so important. If, in fact, over the next 2 weeks, the TVIX does not 3 times, this is double the VIX index. If it doesn't crack 1250 on a closing basis, instead it just keeps treating the 13, 14 area as support, and then it makes a new recovery high, that says we're in place for higher highs and higher lows in the VIX index, because the VIX will catch up. It isn't at this particular point. It's only in peak C. So this is a very interesting phenomenon. However, watch this closely, because if the VIX at 29 right now starts to go down to the 28s or lower, this market will rally back to the highs. If it doesn't, it's saying, be real careful. But if you see the VIX in the 33 to 35 area over the next 2-3 days, you'll see us heading south. Let's just make it real clear. Volatility index moving higher from here says that the market is in the weekend. Volatility index moving under the 20, so 29.44, under the 28s says, short term we can rally a little bit further. I'm looking at this and I'm saying, where will the next opportunity to add to our shorts be? That's the way I'm looking at this market. Hey, thanks for being here. I do appreciate it. Have a wonderful day. I'll be back tomorrow, and just watch that VIX and watch the Dow.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.